Hello everyone. We are going to talk about Chapter 4, long-term assets. We're going to deal with both tangible and intangible long-term assets in this chapter, and in this we'll do tangible long-term assets in this presentation and intangible in the part 2. So if we're going to understand how to account for long-term assets, we need to know basically three things. How to record when we buy them or acquire them when they start, how to record or account for using them over their life, and how to account for when we get rid of them, sell them or throw them out, whichever. Okay, so some things about buying the property and equipment. So we start with tangible. These are things you can physically touch and have physical substance. Okay, the ones that you most often think of in terms of assets. Most of the time when we give examples, these are the kind of things that we generally list as examples. First of all, under U.S. GAAP, we record them at their historic cost. Whatever is paid for them at the time of purchase. At that time, that should be the fair value, right? I mean, because when you go in to buy something and you're willing to pay for it and they're willing to sell it to you, that probably means that's what everybody determines what it's worth, right? And that's what the amount is going to be paid. Okay, so that at the time of purchase, cost and fair value really are the same thing. And then we need to remember that any costs necessary to get it ready to use need to be added in as part of the cost of the asset. So make yourself a little note. When buying assets, there's no such thing as sales tax expense. You don't separate the sales tax out as an expense. Any cost necessary to get that asset ready to use is included in the asset cost. If we're going to track usage of this property and equipment, we're going to need a separate T account called accumulated depreciation. So that is where we're going to track how much of this property and equipment has been used. So we put the purchase of the asset in the T account called property and equipment, and we record how much we've used up in the accumulated depreciation. So that is what we call a contra asset account. We've run into that before. It reduces the amount of the property. It belongs in the asset section, but is a reduction. So that's why it's called a contra asset. The normal balance is a credit, while the rest of the asset T accounts normal balance is a debit. So on the balance sheet, we put total property equipment, the original cost paid, minus accumulated depreciation, that's how much has been used, equals our net property equipment, that's what's left to use, and usually the amount reported on the balance sheet. So depreciation really under the accounting rules is really the idea of spreading the cost of the asset over the time that it benefits. It's matching. It's really matching that expense to the revenue. So if the machine is going to work for 5 years to make widgets, then we're going to take the cost of that machine and spread it over those 5 years so that we can match the cost of that machine against the widgets or the revenue generated by the widgets it makes. So to calculate depreciation, no matter what method you use, you need these items: historical cost, what we paid for it, including any costs necessary to get it ready to use. We need to estimate the expected useful life of the asset, and remember that's going to be specific to the company that owns the asset. So where one company may decide that an asset is useful for 4 years, a different company may because they use it differently, may decide that this asset is useful for 10 years. Just depends on what they use it for, how much they use it, why they use it, that sort of thing. At the end of the useful life, we estimate how much it's worth. And the two terms, interchangeable terms, residual or salvage value. Some people call it salvage, some people call it residual. Same idea. It's what it is worth at the end of the useful life. What could you sell for? Sometimes there's zero. There's nothing. There's at the end of the useful life, all it's worth is to be hauled to the junkyard. Other times, depending on how long the useful life is, there may be significant amount of value in that asset. It's no longer useful to us, but it still has value. The perfect example that I like to use is rental cars. People like to rent new cars. So a rental car company wants to have new cars. They don't want any car more than about 2 or 3 years old or with more than about 30 or 40,000 miles on it. So when their useful life is fairly short, at the end of that useful life, there is significant value. That 3 or 4 year old, 2-year-old vehicle with 40,000 miles has significant value to someone else. It doesn't have useful life, or doesn't have use for the rental car company, but it does for someone else. So they'll sell it, and that would be their residual value, what they could sell it for. And then we have an allocation pattern, and we're going to look at different allocation patterns based on, and that's going to determine our formula for calculating depreciation. Okay? So the first allocation pattern to allocate these costs over time we're going to learn about is a straight line. This is the one that is used most often because it's the easiest and because it's straightforward, easy to understand. So the cost minus the residual or salvage, whatever term you're using, divided by useful life in time. It's measured typically in years, but you could do it in months, so it doesn't matter. But in useful life measured in time equals a depreciation expense. So for instance, there's an example, 50,000, okay, minus the residual divided by 8 equals 5750 per year. That would be every year as long as things go as planned. As long as something doesn't happen to the machine or whatever, we will do that. 5750 per year for 8 years. At the end of those 8 years, it will be worth, we'll have depreciated 46,000, right? The 50 minus the 4, and we'll still have $4,000, which is what we expect to sell it for at the end. If you own it for part of the year, or you want to calculate depreciation for less than a year, you can do it down to a month, divide by 12. That's usually as close as we need to get. We don't need to do this by day. We're not that particular. So you can divide by whatever you get for the year by 12, and then however many months you had it, multiply that by the number of months. Next one gets a little bit more complicated, double declining balance. This is a situation where we're going to take more depreciation. Straight line depreciation is the same every year. Double declining balance has a very high depreciation at the beginning of the asset's useful life, and it drops every year. It gets less. That's why it's called declining. Okay, so it declines in terms of how much depreciation. And this is appropriate for assets that are very useful at the beginning of the useful life, meaning they, when they're new, they're very useful, and then as they get older, they become less useful. It's not so they're not useful at all, but they're less useful. All right, so that's why we developed this one. Okay, note something: the residual is not in the formula, but that doesn't mean that we can. The depreciation goes past the residual. We always consider the residual, even though it's not in the formula. So, a couple of things about this. When you start this formula, cost minus accumulated depreciation when the asset is new is 0. So the first year, that calculation is 0. But then every year after that, it's the all prior depreciation. Okay? So the amount of depreciation is high in the first year. If you need to do it by months, if you want to do it for just months, then divide by 12 just like we did before, okay, and multiply by the number of months. All right, notice the times 2, that's a double in this formula. So useful life and time, all right, on the bottom, just like it was before on the straight line. Let's look at an example. Okay, it costs $32,000 with a 4-year life and $2,000 residual. There's the calculation. $32,000 minus 0, remember the first year, divide by 4, and then multiply by 2. That's $16,000. See, that $16,000 then becomes our accumulated depreciation in year 2. Divide by 4, multiply by 2. That stays the same each time, $8,000. Okay? 32,000 minus 24. Now that's 16 from the first year and 8 from the second year, right? Divide by 4, multiply by 2. And then the year 4, 32,000 minus 28,000. Okay, that's all of that. 16 plus 8 plus 4. Divide by 4, multiply by 2. All right? Total depreciation can never go over 30,000, right? Because we have an asset of 32,000 and a residual of 2,000, so we can never have more total depreciation, okay, than 30,000. So over the course of the life of the asset, the total depreciation is the same regardless of whether you use double declining balance or straight line. All right, and the rules don't tell us which one to use. Companies can use both. Obviously, they should use one for this one asset. They could choose to use a different method for a different asset, but they should be consistent on that particular asset. Last one. Allocation method is units of production. Cost minus residual. So residual is in the formula this time, just like it was. But instead of dividing by time like we did with a straight line, we're dividing by the useful life in units. So this is for machinery or long-haul trucking or something like that, where really something is getting used up based on how many widgets it makes or how many miles it goes or that sort of thing. So we're going to divide by how many miles we think it's going to go total, and then multiply by how many miles it goes during the time period that we're worried about getting depreciation for. Once you have done this first part of the formula, the cost, residual minus divided by useful life, that does not change year to year. That's going to be the same through the whole useful life. Then each year, all you have to do is figure out how many units it went, how many miles it went, how many widgets it made, and multiply by that same one you came up with in the first year. Okay? If you are doing it for part of a year, you don't have to worry about months. All you need to worry about is counting up how many miles it went for the period of time that you're talking about, or you're calculating depreciation for. Okay? Disposal of assets. When assets are sold, this is the idea of getting rid of something, okay, for whatever reason. Typically, it could be at the end of the useful life, it could be before the end of the useful life. When we make that journal entry, we're going to debit for cash, typically, what we receive for asset. We're going to credit the original cost of the asset. We're going to debit accumulated depreciation, and we're going to debit or credit either a loss or a gain. If it's a credit to make the journal entry balance, it's going to be a gain. If it needs a debit, it's going to be a loss. And accountants, because we tend to be a little bit on the lazy side, have determined that we can use a half-year convention, which means we don't have to worry about all those months and such. When we apply the half-year convention, we can assume that an asset is purchased halfway through the year, regardless of whether it is no matter when it was purchased. We don't need to worry about whether it was 5 months or 6 months or 8 months. We just assume it was halfway through the year. And the same thing happens when we sell it. All right? So here is an example of what we just talked about. This kind of the whole process using our journal entries and showing it in our T accounts. So we have our 2 T accounts, equipment and accumulated depreciation, and then a little off our screen right now is our depreciation expense and our loss on sale. Okay, so I haven't hold out the whole accounting equation. Hopefully we can picture that in our mind, just the T accounts we're concerned about. So we bought this equipment for $240,000 in 2019. Debit equipment, credit cash. Okay, so we debited equipment, and I didn't do the cash T account. We would credit in the cash T account. Okay, so this equipment T account and accumulated depreciation had some left over from the previous year, other equipment that we're not focused on right now. We're just worried about right now accounting for this particular piece of equipment. So for 2019, because we bought it sometime in 2019, and its useful life is 10 years and has $20,000 residual, we calculate depreciation for a half year for 2019. We don't care what month it was purchased. We're just going to assume this is the half year convention. We just assume a half year makes our life easier. We don't need to know if it was March or April or whatever. We just need to know it was sometime during 2019, so we're going to do a half a year. And the idea behind that is it's close enough, because we're estimating anyway, to get what we need in terms of correct information on our financial statements. So we're going to do a half year, okay, 240 minus 20,000, divide by 10, all right, and then divide that in half and get 11,000. Okay, that's going to be a credit to accumulated depreciation and a debit to depreciation expense. All right, and recorded in our T accounts. Depreciation expense for 2020, the next year, is a full year, right? Because now we owned it for the whole year. There's no half year involved. 22,000 for the whole year. Okay, debit depreciation expense and credit accumulated depreciation. Same with 20 and 21. Straight line, nice and the same each year. Then we sold this equipment. For whatever reason, it's not useful for us anymore, so we decided to get rid of it. Okay, we sold it for $95,000. But before we can record the sale, we need to take depreciation for the part of 2022 that we owned it. And again, we're assuming a half year. So we just do the same as we did in the first year, right? Well, that was a half year. Now we're assuming a half year again. All right, and we're going to credit accumulated depreciation, debit depreciation expense. Then when we record the sale, we're going to debit cash for what we received. We're going to credit equipment for the original cost, just the one that we're worried about, this piece of equipment that we're focused on, $240,000. We're going to debit accumulated depreciation for the total of all the accumulated depreciation. See, it's going to be the total at 66. And to make this journal entry balance, make the debits total the same as the credits, we need a debit for $79,000, which we said was going to be a loss. So in the T accounts, you see the credit to the equipment, the debit to the accumulated depreciation, wiping out all of this depreciation that we had for the four different years. All right, now on depreciation expense, the thing to remember about an expense is it goes to zero each year, right? So it is doesn't carry over. That's why I put the zeros each after each year. And then finally in 2022, you've got this loss, which goes on the income statement at the bottom, separated from expenses. So the last thing that we just need to throw in here for long-term tangible assets is the idea of repairs or betterments. Okay, so when we had an asset for a couple of years, chances are at some point along the way, we're going to have to spend money on it. Okay, and the question really is it a repair or is it a betterment as to how we account for that extra money we spend on it? If it's a repair, it means that all it's doing is getting it back to the same that it was. It broke and we've got to fix it to make it work properly. All right? If that's the case, it's just a repair expense, debit and credit cash. All right? That's it. That's the easy one. If it's a betterment, meaning that it actually made the asset last longer or more useful. It makes more widgets now. It'll go more miles. It will, whatever about it, it becomes more useful. Then that means it's a betterment. And instead of we're going to debit expense, we're going to debit it to the original asset account, the same account. So if it was when we bought an asset, it was put in the trucks T account. When we improve it, we're going to also put it in that trucks T account. Okay? And we're going to debit that asset, typically credit cash. Now, some companies will just debit accumulated depreciation, but I recommend just putting it in the asset account. Now, because something has changed, it's become more useful, it's going to last longer, whatever, we have to recalculate depreciation. We can't be using the same depreciation we were doing before the betterment. So we have to recalculate it. And the way that we do that is under the straight line, just as an example, we take the old cost, we add in the cost of the betterment, we subtract out any residual, which I didn't put on the formula, or salvage if there was there, and it would reflect any change. If our betterment made the salvage value different, then we'd have to use the new salvage value. Then subtract any accumulated depreciation from before. And then divide by the remaining useful life. How many years left, considering whatever we did to better the asset? So not what the original useful life was, but how many years are now in the future going to be useful. That gets you your new depreciation expense going forward. So part 2 will be intangible assets. That concludes our tangible assets discussion.